too. So we'll look at saving, investment, and the financial system overall. Now, the financial system is very important for long-run growth. If you want to have economic growth, you basically need a well-functioning financial system. So firms can obviously expand through their profits, technical term being retained earnings. So once they're, one of the professors that didn't dress off. So they can take their profits, reinvest that back in the firm, and use that to expand. But in the long run, that's not going to be enough if you want, like, good economic growth. That might get you like 1%, but if you want like 4 or 5%, you're going to need some sort of borrowing. These firms are going to need a large amount of funds in order to be able to expand to like meet this new demand, which is what makes a financial system necessary. So instead of just relying on retained earnings, instead of like going to households to try to borrow from them, firms get funds through the financial system. So these are the system of different financial markets. So there's markets for each different, like, what they call financial instruments, so like stocks, bonds, like government bonds versus like the bonds issued by firms versus bonds issued for like foreign countries and companies in foreign countries. All these different financial markets. Financial system encompasses all of them, and what we call financial intermediaries. So these are different banks, like commercial banks, like where you guys would have like a checking account, investment banks, they'll just specialize in investments, mutual funds that buy shares of stocks in different companies, and then sell shares of that fund itself to individual investors. If you guys watch any movies about Wall Street, like the traders on Wall Street, they might be douchebags, but they are necessary for the economy. You guys watch any like financial movies? Most people like Wolf of Wall Street. At least it's like seeing that. I got on a big kick watching movies about Wall Street a couple months ago. And it's amazing how every single one, like all like the stereotypical finance bros are like so like insufferable. Like, imagine working with them would be awful. But they have this very necessary role in the economy. And we need to somehow be able to match borrowers and lenders. We have these firms that want to borrow so they can expand their operations. They can make capital investments so they can produce more efficiently, offer lower prices to consumers, invest in research and development so they can create new products that better meet consumer needs, or so the new businesses can be formed. We need financial markets for all of that. So the financial market itself is just the market, or the markets, where financial securities, so things like stocks and bonds, are going to be bought and sold. Your financial securities are documents, and these can be physical. You can have, like, your grandma gets you a savings bond when you're a little kid for your 18th birthday, it'll mature. So it can be a physical document, or it can be like a share of electronic ownership. Like, I don't have any paper documents for my 401k, but I still own the stocks in there. And basically the security states the terms from where funds pass from the buyer to the seller. So it'll explain what the interest rate or how the lender gets paid back, how they get made better off from taking part in this transaction. So stock is a financial security where you have partial ownership of a firm, and that lasts forever. As long as you own that stock and the company exists, you will have that stock. Like, there's no end to it. On the other hand, a bond is like a loan, where you basically like loan a company, or you loan the government, whoever's issuing the bond. You loan them an amount of money, a fixed amount of money, say $1,000, and then they'll pay you back that $1,000 with interest over time. And for all bonds that exist today, there is going to be an end date. Usually, like, the longest they'll go is 30 years. When the British government was in like real bad debt after, I think, the Napoleonic Wars, they consolidated all their debt together and they issued these perpetuities called consols. They took them off the last of them off the market in 2015. But until then, you could buy a console bond from the British government, and they would pay you in perpetuity, so forever. You and then your descendants would be paid this coupon every single month. So there's a difference between stocks and bonds. Bonds, you're loaning the company something, there's a limit to the amount of time. Stocks are forever, and you're a partial owner in that company. If you buy a lot of stocks, you buy like 51%, you can be like the majority shareholder and control the company. Or you can buy like one share and have like pretty much no say. But technically, you're still a part owner. And these financial intermediaries are firms that borrow funds from savers and then lend them to borrowers. So they can be banks, they can be mutual funds, pension funds, insurance companies. They can take a lot of different forms, but they're all doing the same thing. They're taking funds from savers and they're lending them to these firms that want to borrow them. So when you deposit your money in a checking account, for instance, that bank, what they do is they take that money, and most of it they end up lending out to a firm. So the cash isn't actually sitting in the vaults. That's because firms need a large amount of funds to expand. They can't just take $1,000 loans from people. They're often borrowing much, much larger sums. So what banks do, in essence, is pull all this money together from savers so they can give a lot fewer loans, but much larger loans. Because the thing about it, if you're a firm trying to get the money that you need to expand your operations, say it costs $100,000, you'd have to go to 10,000 people in order to get all the money you needed to be able to expand. That'd be a very difficult process. It'd take a lot of time finding all those people willing to invest in you and loan that money to you. So we have these banks do it instead. They pull all that money together and then they loan it out. We end up with lower interest rates because the banks are really good at doing this. They know how to assess risk. They hire people that just do that, assess these companies' risk. Interest rates have to be much higher if you had each individual loaning it out. Again, there may be problems with banks, but these financial intermediaries serve a very valuable purpose in an economy. Now, there's three main services that the financial system provides. The first is risk sharing. So if you invested all your money in one company and the value of that company decreased, you'd be in trouble. You'd be kind of screwed. Well, what investors like to do is what they call diversify their portfolio. So they diversify their investments. They invest in a lot of different companies, a lot of different types of assets. So they'll invest in stocks and bonds, maybe some precious metals like gold. That way, if the value of one asset goes down, odds are the other ones are going to increase, and you're not going to lose that much money. So the financial system allows investors to spread their money out over many different assets much easier than if we didn't have it. And it's very easy to design a portfolio that has the same expected return. So you're going to get the same, let's say, 6% a year back, but diversifying it so that you're much less likely to have catastrophic losses. We can talk about that more later on when we talk about the stock market investing more specifically. How to design that. I worked for a wealth management firm, or interned for one, when I was an undergrad one summer. I took a ton of notes on everything. It was really cool to see how you added these different types of assets together with their riskiness of losses, and when you put them all together, you have almost no chance of losing money. Yeah.
Wasn't that how the housing market crashed?
We could do like 4 classes on the financial crisis. That was some of the problem. They had those mortgage-backed securities. Basically, you could go to a financial firm and you could, let's start from the beginning. You take out a mortgage from a bank. Bank loans you the money, you pay them every month. What the banks learned they could do, they learned they could do it because the government started with Fannie Mae and Freddie Mac back in the 60s to increase lending. You could take those loans and sell them to someone else. So you sell that mortgage to a different bank, you get like all that money back, minus like the premium for inflation. Then you can now lend out that money again. Well, over time they realized, hey, there's a lot of money to be made here, so they kept doing that. But not too many people, institutional investors, so like mutual funds or like 401ks, didn't want to like invest in like individual houses. Again, it's difficult to see the riskiness of each borrower. So the banks were like, let's turn these into securities. So they took the mortgages on 100 homes, put them together, and they sold slices of it, like investments in there. So the bank would give you a ton of money if you bought in, and then you would get like the interest payments. So the mortgage payments each month would go to whoever like purchased in there. And they thought because, we put 100 houses together and you're only buying a little slice, that it's not going to be risky. But that's assuming that housing prices kept going up. And eventually they didn't go up. They stopped. We saw a lot of defaults where people realized, hey, like I don't have the money to do this. At a certain point, the houses were what we call underwater. The value of the house was below the mortgage on the house. So if they tried to sell the house, they would lose money and still owe the bank. So we had people just straight up walking away, stopping, like not paying their mortgage and just leaving the house, foreclosing on it. When a lot of people start doing that, whoever is invested in that is going to lose money. There were a lot of problems in the financial crisis, but you're right, that was a huge one. And the assumption that prices are never going to go down, sometimes they do. We could do a whole class on the financial crisis if you guys are interested in that. I love getting to stand up here and bitch about that. Alan Blinder, he's a former Federal Reserve chair, or vice chair, and professor at Princeton. He gives a lecture of like the 12 causes. These 12 things went wrong, and I add 2 additional ones to it. So 14 different things happened to create this like perfect storm. But the mortgage-backed security, huge part of that. I'm trying to think of a way to tie that to risk sharing and say something new instead of just repeating myself. I don't have it. All right. So the next service of the financial system is providing liquidity. Liquidity is the ease of converting some asset into cash. So if you have, I was watching Archer last night. If you have a bearer bond, basically whoever has possession of that bond is like the rightful owner. Very easy to sell to someone and convert to cash. If you have a rare painting, very difficult to convert that to cash. If you have a house, very difficult to convert that to cash because you need to find a buyer who wants that specific thing. If you have a bunch of stocks and bonds in your portfolio, they're very liquid. It's really easy to sell them because we have this market. So instead of needing to go out, asking your friends or strangers on the streets or advertising on Craigslist, hey, I want to sell this stock, when I need money right now, you can just turn to the financial system. You can tell your broker, sell this. Broker finds someone to sell it to, like that. So if for some reason you suddenly need a lot of cash to cover something, the financial system provides liquidity. So not only can you earn this, you earn a return on those assets as their value increases over time, you can also quickly get the cash you need for it, unlike precious art or fancy statues.
Is there like a limit to how many shares of a company?
They issue a certain number of shares. Every company's different. So they may issue like 1,000 shares. And over time, they can increase the number of shares so they can offer new shares, or they can take the shares they already had and split them. So each one stock becomes 2 stocks.
So like you can't just go buy anything you want, like invest in anything you want because like it might not always be there. Like, you know what I mean?
There is a limit to the number of stocks out there. I think it's much larger than 1,000. But the market is so liquid that's not a problem. And if you say you wanted to buy 1,000 shares in a company and they issue 2,000 shares, that's going to increase the price. As like you're buying, you need to find someone else. Your broker say, well, all right, the price is 42, I'll offer you 43 for it, or I'll offer you 44 for it. That'll slowly push the price up until you get all 1,000 of those shares. But you're gonna be paying more money for it. And the last service the financial system provides is it disseminates information. Just like we talked about markets disseminating information about like how good price or the products were, or how consumer demand was increasing or decreasing. We get the same sort of information from the financial system. So these prices of financial securities aren't just random. They represent the beliefs that investors have, the market in general has, about the future revenue of those firms. So the price of an individual stock is increasing. That means that the financial system, so investors, the banks that are financial intermediaries, they think this company is going to be performing well in the future. The price starts decreasing, they have less confidence in that firm in the future and what their revenue stream is going to be like, what their profits are going to be like. So if you want to know how well a firm is doing before you invest, you can look at their stock price over the last 3 months and get a decent amount of information from it. There are a ton of different metrics that the financial system creates to measure how well a firm's doing, and they're very easy to find online. Who do you want to look up? What company?
Amazon.
Okay, there's easy stuff here like the open, so where it was this morning. You can get the high price of the day, the low price of the day. Then there's things like the market capitalization. There's things like the price to the earnings ratio. So what's the price of the stock versus their retained earnings? Include information about the dividend, and then they have information for like the stock over time. So where was it, the 52-week high? So over this past year, the highest price, or previous 52 weeks, what was the lowest price it was at? So you can get a gauge of how volatile it is. We end up with a ton of information. I don't want to store it. Yeah, I'll tell you when their earnings are, if they offer dividends. So sometimes stocks will pay you every like 3 months. They'll give you what's called a dividend. They'll pay you a certain amount of money based off of like how many stocks you own. Yeah, the volume of stocks out there, the number. They gather a ton of different information, so you can understand the health of the firm. And it's very easy for someone to look up and see what's going on. And because we aggregate this information, then we make it easy for investors to see how well a company is expected to be performing. People are more likely to invest in the right firms, more likely to invest in firms that are likely to be, doing well in the future, earning profits, increasing their revenues, rather than just, having a lack of information. You don't know what's going on with these firms, what the expectations of their future profits are, much less likely to pick a winner. So these are the 3 things that the financial system provides the economy. Now, the next two slides, a bunch of rearranging equations and stuff. That's not the most important part that you're supposed to take away. It's not like a skill that you're supposed to develop. Basically, it's proving that savings equals investments. So that's what I want you to take away from this. And we include this because economists like math, so now we have to prove everything we do. So here are the equation for GDP. So Y, your total income, your GDP, equals consumption plus investment plus government spending plus net exports. For example, we're going to assume there's no trading with other countries. There's no investment from other countries. So it's what's called a closed economy. So we'll remove net exports. So now our GDP, our income, equals consumption plus investment plus government spending. We do simple algebra and rearrange that. We have investment equals total income minus consumption minus government spending. And this is just rearranging the equation. There's nothing changing here. So remember that. Y minus C minus G. Very end of our savings here. Y minus C minus G, so the same thing. Now there's two different sources of savings in an economy. There's private savings by households, and then there's the public saving that the government does. So savings, private savings, is household income that's not being spent. So it's not being used on consumption. So household income includes the payments for the factors of production. So that's going to be our Y term again. Transfer payments, so the money that government gives, like welfare, food stamps, those sorts of things. Consumption, C, and then the taxes they pay, T. So the savings is going to equal their payments for the factors of production, plus their transfer payments, minus consumption, minus taxes. So the government's going to save whatever revenue it brings in from taxes, but doesn't spend. So the savings for the government is going to be the taxes they take in, minus government spending, and minus the transfer payments they take from one person or one group of people and give to another. So when we combine those, our total savings, private and public, full expression right there. When you cancel like terms, we end up with Y minus C minus G. Same exact thing we had for investment. So that just tells us that entire investment in economy, that portion of GDP, is going to be equal to savings. Savings by households and savings by the government. So the government has a balanced budget. So their savings is exactly zero. They're not saving anything and they're not needing to borrow. It's a balanced budget, so all savings or all investment in the economy is going to be from private savings. If the government spends more than it takes in, that's a budget deficit. So they end up with negative savings because they're spending more than they're taking in. On the other hand, if the government takes in more money than they spend, that's a budget surplus, so they have money left over. So they'll have positive savings. Now the government funds its deficits. The way they do this is by borrowing. So they sell treasury bonds, treasury bills, treasury notes. The difference between those three is just how long the maturity length is. So it's going to take away the money available for investment spending. So it's going to decrease the savings from private households. Kind of weird spot to include this slide. All right. So in A Christmas Carol, which I'm assuming we've all seen or read. I never read it, but every Christmas I've watched the movie. Was Scrooge a good guy or a bad guy? Yeah, like initially through most of the movie. So how was he good or bad for the economy? Let's say, was he good or bad for growth in the long run? Obviously, he was mean to Cratchit, who worked for him, and like everyone else around him. And he lived a miserable life. Like he wouldn't heat his house; if it cost too much. He wouldn't light it because it cost too much. But because he was a miser, he never spent his money. He saved it. And if he saved that money in a bank, he decides to forego consumption right now and save that money for later. That's more money that's available for banks to loan out to individuals, whether you want to purchase like a house or a car or go to school, and money that can be loaned to firms if you want to, start a new business or expand an existing business. So even though he's being a miser, being miserable in his own life, I mean, being an asshole to everyone else has no effect on the economy. But by being a miser, he actually made long-run growth for all society better off. Then at the end of the movie, Dickens, when he has Scrooge turning a good guy, he spends a ton of money. That's supposed to be like the turnaround. But little, not as good for the economy in the long run. You could say in the short run it was good because now people selling, well, he gets that giant feast, so like farmers involved in bringing all that food to the market, they're made better off by that. But it's decreasing the savings that are available for people to borrow. The textbook talks about like an op-ed that some economist wrote, and I can't remember his name. One Christmas, where he wrote it arguing that Scrooge wasn't as bad as people make him out to be. All right. So now we're going to look at the market for loanable funds. We'll see if we've said that savings has to equal investment because of those equations, but how does this occur? Does this really occur? We're going to model this market just like any other market using supply and demand. The financial system is composed of a lot of different markets, so all the different types of assets, all the different lengths of maturity on bonds. And I mentioned certificates of deposit in banks, which is literally, it's kind of like a savings account. You tell the bank, I'm going to put the money in here for 2 years. I promise I'm not going to touch it. And they don't let you touch it, but they pay you a higher interest rate than they do on like a savings account. But there's all these different types of markets, all these different types of financial instruments. So if we want to talk about savings and investment, we just lump them all together into one market. We call that the market for loanable funds. And this is more conceptual because, again, we're lumping together a lot of different markets, but where borrowers and lenders determine the market interest rate, and then the quantity of loanable funds are going to be exchanged. So the amount of savings and investment. And we're going to assume for all of this that there's no interaction with foreign countries. So no foreign lenders and no foreign borrowers. So we're just working with households and firms, just to keep things simple. So we end up with a downward sloping demand curve and upward sloping supply, just like normal. And the interaction of supply and demand, where they cross, is going to determine both the market price, so the interest rate, and the amount of loanable funds that's taken out, the loans that are taken out. That's going to be the quantity. And firms are going to borrow loanable funds, and they're going to do that from households. Demand is determined by the willingness of firms to borrow to expand their operations and to conduct research and development, or for new firms to start out. But they're going to do this, they're going to take these loans out, they're going to hope to expand in the future and to increase their revenue, to make more money. So what they do is they compare the interest rate to their expected return. So for example, Let's look at Amazon building their new headquarters, the H2Q down in Alexandria. When they were considering that, let's say the interest rate was 12% on that loan that they had to take out to, I don't know, build the facilities and move people there and everything. Is this expected to be a profitable investment? They think so. But it determines what the, oh, I'm sorry, I did that backwards. Let's say that the rate of return on that is 12%. Yeah, the rate of return is 12%. Now, it's going to be profitable for them if the interest rate is lower than their expected rate of return. So if the interest rate is 8%, then yes, it's going to be profitable, so they should do that. If the interest rate is 15%, that's greater than 12%. So no, they shouldn't do that. They'll earn a loss on that. So we end up with a downward sloping demand curve, because the lower the interest rates are, the more projects that are profitable. If interest rates are 15%, you need to have a really, really profitable, idea. You need a really high return to whatever you're going to do, or else the loan's not going to be worth it. Whereas if the interest rate's like 2%, there's a lot more different reasons to borrow that have much lower returns that now become profitable. That's why in recessions, the Fed tries to lower interest rates. They lower interest rates, more people are going to take out loans because more things become profitable. But we get this problem that the Fed pushes interest rates artificially low, then projects that aren't actually profitable become profitable or appear to be profitable because we have these lower interest rates than what the market is than would be if we allowed the market to function efficiently. So the Fed doesn't keep interest rates artificially low like in the future. What's going to happen is those projects that looked profitable at the time will suddenly become unprofitable. So we have the problem with like firms going bankrupt when we have this sudden increase in interest rates. So the company took what seemed to be a prudent risk at the time, but then once the Fed takes that support out of the market, then there's a problem. And we could talk more about the Federal Reserve later. All right. Now turning to the supply side. So households are the ones that supply loanable funds to firms. So when they supply loanable funds, they're going to decrease their consumption. So the goods and services they're spending money on right now. So when you save, you're going to reduce your consumption today, hopefully to increase it tomorrow. Like that's normally the purpose of saving. Now, the higher the interest rate's going to be, the more people are going to be willing to save. And because the more goods and services you're going to be able to afford in the future. So that gives us supply's upward sloping shape. And just like when we talked about normal markets, supply and demand curve, the loanable funds market can shift due to different factors. One thing is government, whether it's through savings or running a budget deficit. There's other changes to the overall economy that would shift the supply or demand curve as well. I think we're not going to focus on that as much in this chapter. Oh. Yeah, before we move on, talk about interest rate on government treasuries. That's because I noticed this in the gym the other day. They were talking, the headline was like, Treasury yields tumble after the stimulus talks stall. That negotiations between Republicans and Democrats on Capitol Hill, I don't know, they couldn't come to an agreement over the next round of stimulus for COVID. So after that, Treasury yields fell. So the yield, say, was, I don't remember the number, say it was 1.5%, it fell to like 1%. So the drop in the interest rate there. So if interest rates fall on government debt, so on like government treasuries, that's going to be a bad thing. That looks negative for the economy. there's a negative outlook for the economy. This is what's called a flight to safety because there's a very low default risk for the U.S. government compared to private firms. So the investors, they fear there's like increasing risk in the economy. So they go for what they think is going to, make them money safely. Think of the interest rates as the price. So as investors buy more and more treasuries, the interest rates they're going to get paid is going to decrease because the government can lower it because of the increase in demand for it. So if you see like on the news, like or on like CNBC or something, they talk about treasury yields falling, that's a sign that something bad is going on in the economy. Do you guys have any questions about what we covered so far?
This isn't a question, but I was in the Christmas club. I never ever did a play until my English teacher forced me to. And I'll show you the picture if I can find it. But the one day at rehearsal, I forgot dress pants because I was dressed up as a man with a suit and a top hat. So I had to wear tights, see-through tights under my suit jacket, and it just looked terrible. It was so embarrassing.
That was for an actual performance or for practice?
It was for the night before, so thank God nobody was there because and I had dressed up as a homeless person. I don't know why I did it. It wasn't even for extra credit, but yeah.
I don't know how to respond to that.
That's okay. I don't know either.
No, I'm sure the pictures are funny though.
Yeah.
All right. Well.